one of the band-aids that they can do is come in and say, okay, so we'll buy older bonds from you. We'll inject liquidity by issuing newer bonds, and that's not net money printing, but it is showing signs of not a particularly healthy market. It's kind of like if there's a popular trading card game, and over time liquidity kind of dried up, and it was hard to kind of there wasn't big volume for buying and selling. So then the company that issued them came in and decided, okay, we'll run a big exchange, and we'll buy them back and resell them, and we'll try to smooth over the low volumes that are happening. It's not a great sign. So I would say there are implications, but it's not the same as money printing.
Hey guys, welcome to Everyday Finance. When it comes to making sense of Bitcoin and the evolving crypto landscape, few experts command the same level of respect and clarity as Lyn Alden, with her roots in engineering, a deep understanding of macroeconomics. Alden has become a trusted voice in a space often flooded with hype and speculation. She avoids bold predictions and flashy headlines, choosing instead to focus on solid fundamentals: monetary policy, liquidity trends, market structure, and capital flow shifts. In her most recent appearance on Cointelegraph, Alden outlines a measured but optimistic outlook for Bitcoin, suggesting that a move toward $150,000 is becoming increasingly realistic, thanks to growing demand and favorable macro trends. Still, she doesn't get carried away, preferring to evaluate the market one step at a time, letting real-world data validate each phase of the cycle. Alden also questions the widely held belief in Bitcoin's rigid 4-year halving narrative, calling it too simplistic. She believes market cycles are shaped more by emotional extremes, waves of euphoria, followed by deep corrections in the global liquidity environment. What we're seeing now, she suggests, might be a stretched out, more subdued cycle still upward, but influenced by tighter credit, evolving investor behavior, and a more mature market structure. Looking ahead, Alden zooms in on the metrics that truly matter: institutional adoption, stablecoin dynamics, and global monetary policy, all key forces that could shape where the market goes from here. If you want to understand what's really moving the needle in crypto right now, this is a conversation worth your time. Don't forget to like, share, and subscribe with notifications on so you never miss an update.
Yeah, we absolutely could. The question is, where is the incentive there? Do any of the people that run the system want to do it? And then even the voters, if they say they want to do it, but then it's like, well, okay, so we're going to do austerity now, and your Social Security checks are going to get clipped, and like, well, no, I don't want that. I just want the good side, not the downside. I don't want anything to happen to me. And so between the voters and the politicians, the fiat currency debasement is kind of the release valve. So as they fail to agree with each other on how much to tax, how much to spend, the error just gets kind of invisibly debased and argued over, and kind of the impacts happen with a delay. So I think nothing short of a forcing function is needed, which is basically it's going to keep happening until something forces them otherwise, which is to say until there's something really powerful in their face, like Bitcoin is 10 times bigger than it is now or something. They're going to keep doing it. So I would say that bonds have been a kind of safe haven for a shorter period of time than people think. So if you go back, for example, from the 1930s all the way through the 1970s, bonds were like one of the worst things you could possibly invest in. Almost anything else is better than bonds and currency. It was like a structural, like a generational long bear market in bonds. And sure, during brief recessions, in some cases they would do well, but other times they wouldn't. It'd be like an inflationary recession. And then from the 1980s through the 2010s, they took on this safe haven aspect, and that's the operating history for most investors today. So in current investing lifetimes, they view U.S. And other kind of developed government bonds as safe havens, which is long in the sense that it's like a 60-year-old or 70-year-old investment manager today. It's been throughout their entire career. But it's not really before that. And so, we grew up with it, or we operated with it. And that regime can change. And I would argue that it already has, because I generally argue that we're back in an environment that looks more like the 1940s. I think we're starting another cycle where bonds and currency are just not defensive assets. They're more in the structural debasement period. From the 1980s, from that point, the bond bear market was so bad. They already got most of the purchasing power wiped out. And then we kind of reset with a very low debt level at the sovereign level and to some extent the private level. So low debt, they were able to, in the 80s, run a very hard monetary policy, at least as far as fiat currency goes. And that kind of started the next bull market in bonds. But we've spent 40 years tapping into that. And now we're back into a state of high debt, which is generally a period of time where bonds and currency are not going to do well. And I mean, I wrote an article in 2019. Are we in a bond bubble? And kind of analyzed the whole thing and decided yes, we are. And it's been like the worst 5-year period for bonds like in history. Like it's been catastrophic for bonds versus every other asset that you could almost possibly own. And I don't think it's maybe going to be as bad, say, the next 5 years as those 5 years. Like that was like unusually bad. But much like the 40s or the kind of the late 30s through the 70s, I think we're in a more structural period of bond just not being great anymore. Well, so it's very different than QE. QE is money printing. Now there's certain qualifications to that statement, but QE is money printing because, and some people will say QE is just an asset swap, but they create money and then they swap it for an asset. So it's an asset swap with one side's being created out of nothing. So QE is money printing. Treasury buybacks are not. They're issuing newer bonds and they're retiring older bonds prematurely. And so that there's no net money added to the system. And so I think overall it's getting more attention than it should. It has, not to say that it's irrelevant, but it's kind of being overly focused on. But the implication that it does have is part of why treasuries are, going back to the prior question, how do treasuries get to the heart of the system? It seems kind of unintuitive. It's because they've been like the biggest, deepest, most liquid market compared to most other things. It's also, I mean, the dollar itself is a very deep and liquid market, and then treasuries are a very deep and liquid market. In recent years, that's becoming less true, which is to say that the one way of measuring this is the total size outstanding of U.S. government bonds has increased faster than the daily, weekly, or monthly trading volume of bonds. And so if you're a big bond holder, especially longer duration bonds, like if you're a big insurance company or a bank or asset manager or sovereign entity, some sort of big entity, if you want to be able to sell, just like snap your fingers and sell $1 billion of bonds like in the hour, or sell 10 billion that day, it's now not necessarily liquid enough for you to do that without moving the price. So kind of the whole selling proposition of why bonds are so great is impaired if they're not very liquid. And part of the reason they're not very liquid is because there's not just one type of treasury bond. There's multiple different durations of bonds and a couple different types, like inflation protected or not. And so the liquidity is fragmented into a handful of different buckets. And a lot of those buckets are not as liquid as market participants would like. And so one of the band-aids that they can do is come in and say, okay, so we'll buy older bonds from you. We'll inject liquidity by issuing newer bonds, and that's not net money printing, but it is showing signs of not a particularly healthy market. It's kind of like if there's a popular trading card game, and over time liquidity kind of dried up, and it was hard to kind of there wasn't big volume for buying and selling. So then the company that issued them came in and decided, okay, we'll run a big exchange and we'll buy them back and resell them and we'll try to smooth over the low volumes that are happening. It's not a great sign. So I would say there are implications, but it's not the same as money printing.
Lyn Alden's central argument is straightforward. While the traditional 4-year out, Bitcoin halving cycle still influences market psychology. It's global liquidity, not the halving itself, that now plays the leading role in driving Bitcoin's price trajectory. As Bitcoin evolves into a multi-trillion-dollar asset and becomes more intertwined with traditional finance, its performance is increasingly shaped by macroeconomic forces like interest rates, credit cycles, and international capital movement. Alden highlights key on-chain metrics such as the market value to realized value (MVRV) ratio and HODL waves as more reliable tools for identifying where we are in the current cycle. These indicators show that we're not in the euphoric excess typically seen at market tops. While some long-term holders are beginning to take profits, the pace isn't aggressive enough to suggest a full-blown exit is underway. In Alden's view, that supports the idea of a cycle that's still healthy, just slower. It's longer and less dramatic than past ones. Yet even amid this cautious optimism, she doesn't ignore the broader macro backdrop, which flags rising concerns about the U.S. fiscal position, pointing to aging demographics, persistent deficits, and the rising cost of debt as long-term challenges that may undermine confidence in the dollar. For Alden, this kind of environment only reinforces the appeal of hard, scarce assets and strengthens the long-term case for Bitcoin. So where could all of this take us? If liquidity continues to improve, if structural fiscal pressures persist, and if long-term holders maintain their current behavior, Alden believes a push toward $150,000 for Bitcoin isn't just a hope, it's a growing probability. In the next part of the conversation, she outlines her roadmap for how and when that target could become reality.
So if they meaningfully shorten duration, which happened under Yellen, even before they were doing buybacks, so you don't need buybacks to shorten duration, because you can just let older bonds mature and then issue newer debt with shorter durations. So it's almost a separate question. But you can accelerate it if you then also buy back longer duration existing bonds and issue T-bills to do it. If you meaningfully shorten debt duration one way or another, that has kind of pro liquidity ramifications. That's something that emerging markets do. During extreme currency crisis, like Brazil went through this, like who would want to own a 5-year Brazilian bond if they're having super high inflation, which they did, decades ago? They'd have to kind of like issue most of their debt like overnight, just really low duration stuff. And so it's a sign of an unhealthy market, and it is a way of kind of more liquefying it, because it's way easier to hold a T-bill if you're a bank or something, or even an individual, than it is a T-bond with all that volatility risk. So that would be more direct intervention. At the current time, they're not dramatically reducing their average duration, but they did that over the past couple years. They might certainly do it in the future. Right now, they're kind of in this holding period. Yeah, to some extent. Yeah, absolutely. And that's actually one of the issues where, because we're no longer at a structurally declining interest rate, things start working differently than investors have been used to for their entire investing career. 40 plus years of structurally declining interest rates are over now. And so even if they're not going structurally up, if they're just going structurally sideways, we're in a new environment. And so it's not like, it used to be that basically all new issued bonds had lower interest rates than older bonds, and we're not in that environment anymore. Now, the amount of buybacks that they're doing relative to total debt, I would say, are not moving the needle a ton on total interest rate compared to just the amount that's outstanding. If you're doing tens of billions of buybacks and there's tens of trillions of debt outstanding, it's not like you're meaningfully changing the interest rate profile, which is why I think that overall this topic currently gets more attention than it probably deserves compared to other things that are happening. Not to say it's irrelevant, but yeah, that's certainly a factor. So I think at the very least, we're in the later stages of a long-term debt cycle, which is to say, the way that generally works is you build up a ton of debt in the private sector over decades. Every time there's a problem, you lower interest rates and encourage that debt to keep going up again. Because again, central banks, they pull forward stuff. They want to put out the fire in the short term. When you hit zero interest rates and private debt levels are super high, there's really nowhere else to go. And so then you start to get more fiscal response. And it's accompanied by central bank money printing. And what happens is that you rotate some of that debt onto the sovereign level. So you deleverage, not necessarily nominally from the private sector, but as a percentage, and you push more of it to the sovereign level. And then it really has nowhere to go other than default, or if it's in their own liabilities, then print and debasement. And I would argue, I mean, we're 5 years into that. I mean, this has been a catastrophic 5 years for purchasing power of bonds and currency. I think we have much longer to go. Now that you can kind of do it all at once with like very high inflation, or you can do it over a prolonged period of time, or a combination of both. You can have like a prolonged period and then a sharp kind of rip the Band-Aid off moment. And so I do think we're in the later stage of a long-term debt cycle, which is basically where currency takes the brunt of the impact more so than, say, private sector nominal defaults and things like that. Um, Whether we're late stage fiat or not basically comes down to the question of whether there's going to be another long-term debt cycle after this, or if technology will have transitioned enough that there's viable alternatives at scale, which goes back to the earlier point. So if this happens while Bitcoin is worth $1 trillion or 2 trillion, then yeah, we probably kickstart a whole nother cycle. I mean, if it gets bad enough, nation states could back their currency by some degree of of gold. And so you have a kind of debasement. Yeah, as things are just kind of getting out of control, they kind of manage to solidify kind of like they did in the 80s. And basically kind of just, you burned off a lot of debt and now you kind of like stick the landing and harden everything and kind of try to rebuild trust. And that can work for another couple generations. Or if Bitcoin's really big by the time we get to that point, then it more permanently solves the issue that the telegraph opened a century and a half ago, and it becomes less viable to even hold central bank, nation state issued assets. Because if Bitcoin's a really big global settlement network, and it's really liquid in multiple currencies, and you're a central bank, why would you hold dollars and treasuries, which are debasable and confiscatable, when you could hold Bitcoin and you can still move it around as quickly as you could treasuries? But it has to be at a scale and a lower volatility that would interest them.
Lyn Alden stands out by grounding Bitcoin analysis in macroeconomic reality rather than hype. She believes the 4-year halving cycle is becoming less relevant, with liquidity and global financial conditions now driving price action, using tools like the MVRV ratio and HODL waves. Alden sees signs of a healthy mid-cycle, not a market top. On-chain expert Willy Woo shares a similar outlook, but expects faster upside, fueled by ETF demand and institutional accumulation. While Woo leans bullish, Alden expects a longer, steadier climb. With Bitcoin potentially reaching $150,000 this cycle, both agree. Bitcoin's bull market is structural, backed by weakening fiat systems, institutional adoption, and a shift in how the asset is perceived, moving from fringe speculation to a serious macro hedge